Daryl Liew, you're head of portfolio management at Reyl at Singapore. Now, about a year ago, this Chinese economy started to plummet, also the stock market, of course. Looking back over 1 year's time, where are we now?
Well, I think things have definitely stabilized a lot in China. Basically, since what we saw about a year ago, Chinese government has come out to basically underwrite that the GDP growth in China, for example, will hit 6.5% this year. They've addressed a lot of the policy mistakes that they made as well over the last several months. The communication, for example, in terms of how they will manage the renminbi has definitely helped stabilize the situation. So together with fiscal stimulus and targeted measures, economic numbers coming out from China has definitely been quite strong over the last few months, and that has helped the Chinese stock market.
But will the government be further in a position to contain the problem, and have there been enough reforms from the political side?
Yeah, the reform question is a good one. Effectively, it seems like they're a bit like taking two steps forward and one step back to a certain extent. But having said that, there's still some measures that are taking place. For example, the moves to curtail the overcapacity issues in the steel and coal industry. They've undertaken that over the next 3 to 5 years, they're going to be cutting the oversupply situation by about 15 to 20%. They've come out with measures about how they're going to basically be retraining the 3 to 4 million people which will be affected. So there are some measures that are being taken, also to address, for example, the NPL issues in the banks. But of course, the criticism has always been, can they do more? But I think they're addressing some of the issues that people are concerned about.
A big topic about China is always data. How reliable is data coming out of China?
Yeah, the data issue is one that has been plaguing the country for a number of years. People say, for example, how is it possible that they're still growing at high single-digit numbers? Also, the issue about NPL figures. How can it be so low when you look at it in the marketplace? You can definitely see that defaults are starting to happen. Banks are definitely under a bit of stress. So data is an issue, but I think what we can rely on is what we can see in the marketplace.
What is your prospect for the Chinese stock market?
Well, we are still quite constructive on the Chinese market, because if you look at it on a valuation basis, the China 8 share market, these are China stocks listed in Hong Kong, for example, are trading at a forward PE of something like 6.5 times. So I think a lot of the bad news is priced into the marketplace. No doubt the 6.5 times is because of the financials. Chinese financials are dragging the whole numbers down. But having said that, if you look at the earnings growth potential, especially in the consumer sector in China, there are quite a number of interesting buying opportunities in Chinese stocks.
How do European investors invest in China?
Well, there are various means for European investors to invest in. You can invest in a fund, or if you want to invest in direct stocks, you have direct Chinese stocks listed in Hong Kong or US ADRs. And now with the Connect program, the Shanghai-Hong Kong Connect program, foreigners can actually invest in China A shares in Shanghai through Hong Kong as well.
Are there further connects that will be there in the Chinese stock market?
Yeah, there's a potential another Shenzhen Connect program which is poised to be launched in the next several months. That would basically help support the existing Shanghai-Hong Kong Connect, because right now you can buy all the stocks that are listed in Shanghai. But moving forward, once the Shenzhen Connect program gets set up as well, you can also buy stocks that are listed in Shenzhen.
You're based in Singapore. How does the Chinese situation affect Southeast Asia?
Well, I think both pros and cons. No doubt, whatever happens in China, they used to say that whenever the US sneezes, the rest of the world catches a cold. At least for Asia, we are more heavily dependent on what happens in China. So if China catches the flu, we all get affected as well. But having said that, there's a couple of things that are happening which have positioned Southeast Asian countries in a positive light. One of which is that China is going through some restructuring. So low-cost manufacturing, is something that they're moving away from, moving towards more higher tech, higher value-added services. And because of that, some of the low-cost manufacturing is actually coming down to Southeast Asia, to countries like Indonesia, for example, or Vietnam. So I think there's opportunities there for a number of Southeast Asian countries to actually benefit from the current restructuring that we are seeing in China. But besides that as well, China has also got a major theme that they've been concentrating on, this One Belt, One Road theme. They're trying to redevelop the Silk Road, the connection between China and Europe, for example. They've embarked on a huge infrastructure spending program, both over land and on sea. And that is going to help improve the connectivity within Asia, intra-Asia trade as well, which will be a huge positive for Southeast Asian countries.
And how is the situation for the Swiss wealth management in Southeast Asia?
Well, I think Swiss banks still have a very strong reputation in Asia. However, the issue is something that's plaguing the entire banking industry. I think a number of banks have probably overextended themselves. There's a bit, maybe too much capacity. So what we've seen over the last several years is that banks are in the process of rationalizing their operations. So we've had a number of mergers, for example, and exits from some of the European banks, not Swiss, but other European banks, for example, French banks, British banks, which have sold off their operations to local Asian banks, and we could see more rationalization moving forward as banks concentrate more on the bottom line rather than top line growth.